Yeah, I have not. Okay. Grimm Walker is a venture firm that activates the potential of women in business through programs, community, and direct investments. We are on a mission to reshape the public markets by investing in technology companies led by women and non-binary founders. Part of that programming includes sessions like today, where we get to bring in amazing people like Stephen Plappert and Ahva. Stephen is co-founder and CEO of Forecastr. He's a 2-time Techstars alum and serial entrepreneur that loves helping other founders. He spent 4 years providing outsourced financial leadership to growing companies. And when he isn't working on Forecastr, you can find him in the woods, camping and rock climbing. Forecastr and Grimm Walker go way back, and we're always proud to say that we were Forecastr's first paid partnership. And they are also a startup, so they're right there in the trenches with all of you fundraising right now. They know what they're doing, so this is going to be a really great session for you. And we also have Ahva Sadeghi. Did I pronounce that correctly?
Yes, you did great.
Awesome. He's here with us, co-founder and CEO of Symba. And I will pass it over to you to kind of intro yourself and your company, and we can go ahead and get started.
Thank you. So excited to be here, especially to create a forum like this. We need more women fundraising, more women in tech and building. So really honored and excited to share my story, especially excited because Stephen, I think we were one of your earliest paid customers. So I know you're a paid partnership, so full circle, but we've been so impacted by the work that their team has done to help us go out and raise. So we are the less than 2% of women who've raised venture capital. So excited to share our story today too.
Cool. Well, Jen, I'm happy to take it from here if that's good. All right, cool, sweet. Well, awesome. Well, it's great to see all you guys. And if you're maybe joining us for the whole series, because we've done this is the third part in a three-part series, or if you're just kind of zooming in today for today's session, I'm thrilled you're here. I'm happy you're here, and we're going to try to provide as much value as we can in 53 minutes. And we got a lot of ground to cover. So I'm going to share my screen and we'll get started. While I'm doing that, I'll just say we got Calvin here. If you want to give a wave, Calvin. Calvin here is from the Forecastr team, so he'll be kind of working the chat and that kind of stuff. So if you got a question, please feel free to raise your hand or drop it in the chat. We'll make sure that we get those questions answered because we're here for y'all. We're here to try to answer your questions and try to add value, to try to help you raise capital. That's really what we're focused on today is our kind of guide to raising capital. There's a lot of tips and tricks that we have in this session today. Try to make it really actionable, really digestible, try to break the process down. So I hope you get value out of it. And I'm thrilled to have Ahva here with me. We went through Techstars together years ago, and it's been super cool to watch her grow her company and to be doing that alongside her. And yeah, just thrilled to have her here because I think she'll be really helpful. So I'll kind of go through some stuff and I'll pull you in and kind of ask you questions about your story as we go here. So yeah, we'll dive right in. So Jenna did such a great job of introducing me, so you kind of know who I am, but serial entrepreneur, been in the game 10 years, started 2 companies, taken them both through Techstars, been a finance guy kind of through and through. So startups and finance, that's my game. Fundraising, I think I do a pretty good job of, and like Jenna said, I'm right there in the trenches as well. So we're raising $4 million for Forecastr. We're putting on notice of the grindstone on that round right now. So everything that we're talking about, today, I've used in my career to raise about $8-9 million in venture capital to date. I'm also putting to work right now in this $4 million round to try to achieve similar success. So a little bit more about me and kind of what gives me the right, so to speak, to be chatting with y'all today. And then just a little bit about Forecastr. So, like Ahva said, she's one of our earliest customers, super thrilled to work with her, but Forecastr is an online financial model. And what we do is we help founders build great financial models so that they can raise capital, so that they can manage their growth and so that they can manage their cash. We're helping people manage their runway, set and hit growth targets, and then ultimately raise capital, like tell your story investors, and it's just an alternative to Microsoft Excel when it comes to doing that. Calvin can drop a link in the chat for anybody who wants to schedule a demo. And we've worked with dozens of Graham and Walker companies. Absolutely love the companies we get from Graham and Walker, because they're always great founders and they're always great companies and they're just great people to work with. So of course, we'd be thrilled, to go to work for you as well. That said, I'm always very careful to say, I'm not here to pitch you on Forecastr. I'm not here to sell you on Forecastr. I'm not here to try to get you to become a Forecastr customer. I'd be thrilled to work with you because you're probably awesome, but I'm just here to talk about fundraising and to try to help y'all raise capital. So don't feel any pressure. And what we're going to do here is just kind of work our way down this agenda. So we're going to talk a little bit about raise preparation. And this actual session that we have today is part of a kind of a separate 3-part series that we do. So we're going to reference, a little bit of that, but we'll talk a little bit about raise preparation, what you need to do to get prepared to raise capital. We'll talk about kind of the stages of a round, momentum, setting terms, closing the deal. And then we've got some kind of, some digestible kind of quick tactics that you can put to work in your round to help raise. And we'll kind of pull Ahva in here and see how her experience, either aligns or maybe differs from some of the stuff that we'll talk about. So bunch of stuff. I think it's going to be great. But getting right started. So raise preparation, right? So there's this kind of famous saying that I really like where I think it was Abraham Lincoln or something like that. But it's like, if you give me 6 hours to chop down a tree, I'll spend the first 4 hours sharpening the axe. And I think that's a really good mindset to be in when you're fundraising. Is it's a game of preparation. You got to get ready for the show. You got to make sure that you got all your ducks in a row before you get out there and go try to raise capital, because it's a competitive process and you need to look better than everybody else. So the more polished you are, the more prepared you are to answer the tough questions, etc., the better off you'll be. And so there are some things that you need to prepare when you're getting ready to raise. So these are the big 4, kind of as we call them. You want a pitch deck, you want a financial model. So these 2 things are actually going to do the same thing for you. They're going to help you tell your story. The pitch deck is going to tell your story kind of visually in a more charismatic way. The financial model is going to help you tell your story in a more numerical way. And that's the idea, is that you can tell your story, kind of charismatically in the first meeting, and then you can back it up with numbers that tell that same story of how you acquire, of how you monetize, etc. That's really the game that we play at Forecastr, is helping folks tell that numerical narrative. But then there's a couple other things as well. You need a data room. And so a data room is going to be like an organized list of different diligence documents that an investor might want to peruse. Things like your cap table, things like your articles of incorporation, things like your historical financials, things like like a copy of your pitch deck, or maybe some customer testimonials and things like that. It's also something that we have a nice template of that Calvin can drop in the chat. We have like a kind of a free, just a folder structure basically that you can use to kind of organize a data room if that's useful. And then the investor pipeline, I think, is arguably the most important of the 4. I think a big part of fundraising is just getting the meetings. It's getting the at-bats. It's like it's taking the swing, so to speak. And if you don't have a really good, healthy investor pipeline, you run the risk of stalling the round out, of not creating enough momentum and scarcity and things like that. And we'll talk about that. But I think it's really important that you kind of do that work on the front end to really build a healthy pipeline before you start raising capital. You'll see a theme here, but another thing we offer a free template on that we can share is just like an investor pipeline template that we use out of Google Sheets. Ahva, anything you want to add to this about your kind of experience around like materials or preparation when you get ready for a round, anything like that?
I think that one thing that's also really important too is like think about the story and the narrative that you want to go out into, and like how does that tie everything together. I think that the pitch deck is really ultimately that, but like how does everything that you're telling in the pitch deck like resonate in every single thing that you're doing? like whether that be like how you tell the story of your financial model, how you put together information in your data room to back up everything in the pitch deck, and then hopefully investors in your pipeline that resonate and care about that story that you're telling. So really make sure that theme flows through everything, and it kind of like all works in conjunction to kind of like double down on every activity that you're doing. But I'm learning right now too, Steve, I'm excited to take a look at your template and see how you run that process, because we ran it a lot like a sales process and how we got introduced to people. So thanks for sharing.
Yeah, it's a couple of really good points there. One being running your raise like a sales process, because I think that's how you should think about it. It's kind of a financial sales process. And I think that's really helpful. I think you're absolutely right. It's narrative first. It's like you got to come up with that story you want to tell. And then how does that story express itself in the deck? How does that story express itself in the model? But it's the story that you got to get right on the front end. So I think that narrative first approach is a really, really good one. And there's another thing that we talk about you needing on the front end, and that's kind of trust and confidence. And this is where we start to get into this kind of people-centric guide, because at the end of the day, as much as investment is a transaction, right? And it is about dollars and cents at some level. It's a people-centric game. It's a game of people. Like, it's a relationships game. It's a trust game. It's a confidence game. There's a lot of these elements that come into play a lot in fundraising. And so don't underestimate the fact that if in order to really kind of create a bridge and get investment, you need to get them to like you as a human. It's a very basic thing, but it's kind of true. It's that, it's like people want to invest in people that they like. They want to work with people that they like, et cetera. And so taking that time to build a human connection, right, is really important. And don't jump too quickly just into the dollars and cents, because like a lot of people are people, and they want to build those relationships. And I think a lot of investment is about trust and confidence. It's about an investor building conviction, building trust, having confidence in you, in your plan, in your business, in your vision, in your team, and so there really is a level of trust that has to be built up. And for most people, building trust takes time. And that's what we talk about a lot when we talk about raise preparation, is in addition to those materials, if you can, you want to build some relationships with investors and start building trust, so that when it comes time to do a deal, it's just go or no go, not like, who are you and are you even trustworthy and what's going on with your company. I think if you get through some of those things earlier, you can get to quicker no's and yeses when you actually go to raise, because they already know, hey, you're a great founder, she's awesome, I really like her, all that kind of stuff. It's just a matter of, am I going to be in this deal or not? Not like, I don't know her from Eve and yada, yada, right? So I think the more you do that on the front end and do these things we call trust building touch points, just grabbing a coffee with somebody, maybe giving them a demo of the product or asking them a question, that kind of stuff is important. And we kind of break things down into like vision and execution. You want them to walk away, from a first meeting with you or that kind of thing, with saying, hey, there's a big vision for this company. There's a big pot of gold at the end of the rainbow. And like, man, I think she actually knows how to get there. I think she can execute. I think she can execute, and I think there's something to execute for. I think if an investor can put those two things together, you're well on your way to getting a yes. You're well on your way to getting a check. So we talk a lot about kind of building trust and building confidence, and I would think about it in that way. How can I get this investor to trust me, to have confidence in me? How can I embody the kind of confidence that I want them to have in me, to inspire that confidence? So that's the other thing there. And so you get all that done, right? You're ready to raise. Then we kind of break it down into 3 stages of execution when you're ready to hit go. The first and to me the most critical stage is the momentum building stage. So raising capital is very much a game of momentum, and it's a game of creating scarcity where there kind of is no scarcity. And I think you do that largely through volume and through very intentional, approach to the market, something we call investor blitzing, which is what we're going to talk about in a second. But you have to kind of create this artificial scarcity, so people are saying, oh crap, like this deal's really hot, I'm going to miss out on it, I'm jumping in. and that momentum has a way of building on itself. And that's why you want to have that nice juicy pipeline. That's why you want to be prepared. So when you go to market, you can hit the market hard so that you can create that momentum and create that scarcity kind of out of thin air. So we're going to talk about that. And once you've built that momentum and that momentum's like grown to a crescendo, right? Like then that's when you're going to try to set the terms, catalyze that, and turn all that momentum into a deal that you've closed and into money in your bank account. So we'll talk about kind of that progression as well. So one of my favorite topics in fundraising is something we call investor blitzing. And all that means is basically you want to create FOMO, scarcity, momentum. How can you do that? Well, one way you can do it is by being really targeted with how you set your meetings and trying to set meetings in a very short amount of time and a fairly large volume of meetings. So let's say you have 50 investor leads. Instead of like waking up one day and saying, okay, I'm fundraising and reaching out to all those 50 and being kind of willy-nilly about scheduling and like 4 schedule this week and 5 schedule next week and 3 schedule the week after that and then 6. And it just kind of all drags on and everybody's just kind of sitting on their hands because there's no real pressure. A better way to do it is take those 50 leads, put them into waves. So wave A, make that be your friendlies, your quick yeses, right? People that maybe you've already built a relationship with. You're like, hey, I think this person's going to be a quick yes, or I think that this person really knows me. They love me. I think they're going to be in. Like you have your kind of wave A slice. Then you have your wave B, which are like, man, these are like your dream investors of the 50 you have or the 100 you have, whatever. These are the ones that you really, really want. And you're going to put them in the middle because, you want to have a refined pitch by the time you get to them. You don't want to be working out the kinks on these folks, right? You want to work with the friendlies, try to get some quick yeses, try to build some momentum, work out the kinks. So then when you're going into wave B, you're sharp, you're polished, you know what questions you're going to get. You're answering them, left and right? And you bring your best foot forward for that wave B. And wave B gets the benefit of seeing this momentum. You're like, hey, I'm 2 weeks in. I've already got $300,000 committed to the round or $500,000 committed to the round from these friendlies, right? So you're going into wave B. Wave B is saying, hey, this pitch is really sharp. There's a lot of momentum going in this round, right? And so like wave B, it's going to be a higher conversion rate for wave B because you're kind of attacking them second in that way. And then wave C would be kind of folks that you're like, they're not really friendly. I don't think they're going to be like a quick yes. And they're not really like a top target. They're folks that I think are absolutely good people, absolutely would have them on the cap table, would take investment from them. But, I'm not like dying to have their money, so to speak. And so you can kind of put them in the back end of the process. And those would be folks that would probably want to follow, one of the earlier waves. They would want to see a lot of momentum in order to jump in. Maybe they want a lead investor in order to jump in, which would be kind of your wave B, and so there's this notion of like being intentional about the ordering of the meetings to try to create as much momentum as possible. And then being really intentional about the amount of the time frame. So what I like to do is get ready to raise and be ready to raise at least like a month in advance. And then reach out to a bunch of people and say, hey, I want to schedule you for this point. I'm going to launch my round at this point and get out ahead of it, and in that way you can kind of get your pick of the litter. A month out, a lot of people's calendars are pretty open. So you can say, hey, can you meet Tuesday at 8? They're like, yeah, you schedule. Can you meet Tuesday at 9? Can you meet Tuesday at 10? Can you meet Tuesday at 11? Right. And you're ordering them up. And it never works out like that, right? I mean, people kind of shift around, but in general, you can kind of get a wave A, B, and C, and you can get all those meetings in a short period of time. Like when we raised $2.5 million in a seed 2 years ago. And I don't know if I would suggest going this hard because this was a lot, but I had 35 to 40 meetings a week for 4 weeks straight. I did 160 meetings. We were fully subscribed on that round in 6 weeks. It objectively went very well. It was a little bit of a nightmare to manage. And it was a lot. It was just a lot. And I felt like I was running around, really. I didn't feel like I was perfectly ready for all those meetings. So I might suggest kind of peeling that back and maybe trying to go 25 meetings a week or 20 meetings a week or something like that. It's probably smarter. But the key is have meetings in a short window of time to try to create, artificial scarcity. Because if 3 or 4 out of 20 say yes, all of a sudden, boom, you've got, some really solid momentum. versus if you only had 6 meetings set, you might get one, in which case, like, it's just hard to build it. So hopefully that makes sense. Ahva, I'm curious if you have any thoughts on this, or like when you've raised, how did you approach kind of like scheduling the investors or other kind of momentum building tactics?
I think that the strategy that you share is really, really helpful because it also like gives you opportunities to take a deep breath between each wave. You're like, okay, going into this gear now, going into that gear, and you kind of set yourself up for success by saying, okay, at this point, when I've exhausted this, I'm going into this moment, because what you don't want to happen is get into this fundraising state that feels like it's endless. And, when you're fundraising, typically you're supposed to be just fundraising. And so that obviously means the commercial side of your business is not moving as quickly as it could be. So time boxing these activities is so critical and important. I love the advice that you gave, Stephen, around like blocking out a portion of time on your calendar. I know Hustle Fund actually has this strategy where they encourage their founders to go out and raise and say, okay, we're only going to go out for these 2 weeks, block their calendar, only do that. They make the announcement like a week before. They don't do a week follow-up, and then they send out the link to see who is interested. And so they try to build hype and FOMO. So it is a fun game in a way. So if you lean into that and like realize it's kind of like that element, then you can have fun with it and be comfortable going through that process because it is fun and it is exciting and very exhilarating. I'll share.
Yeah, totally. And it can be, like you said, it's like, and I think, for a lot of people, fundraising can be one of the most challenging aspects of the business. But I think, like you said, it's like, if you really just lean into it, commit yourself to it, and I think it can be a kind of a fun and cool process as well. So there's this whole idea of kind of blitzing. And then another way that we can generate momentum is by lowering the bar for a commitment. So instead of what some folks do, instead of leading with terms, instead of saying, hey, I'm raising 2.5 million and I'm doing it at 10 million post-money valuation, blah, blah, blah. Like, take that whole term thing off the board. And when you first start presenting to investors, meeting with investors, pitching investors, don't have a price attached to it. Just say, hey, we're looking for 2.5 million to reach these milestones, or we're looking for $1 million to reach these milestones, whatever the number is, right? We're looking for 500K to reach these milestones. You're raising a certain amount of money to get to a certain spot, to get to milestones, not hire people, not get time. You're raising money to get to milestones, and you're trying to just generate interest and generate people that are saying, yeah, you know what? I think you're going to do it. I want to invest in that. And if they say, hey, well, what are the terms? Like on what valuation are you raising? You can simply say, we haven't set a price for the company. We're not optimizing for valuation. We're optimizing for the best possible investors, and we really want to work with the best people here. So we're trusting that we work with the investor group to come up with terms that are fair and reasonable. Assuming the terms are fair and reasonable, and if they're not, I had never hold you to this, but assuming the terms are fair and reasonable, assuming I put a deal on your desk that has fair and reasonable terms, would you be willing to commit? Like, how much would you like to invest in the company? And this is considered a soft commitment. I learned this from Techstars. I learned this from David Cohen at Techstars. That's who taught me this. Is this idea of a soft commitment, getting someone to say, yeah, you know what, assuming the terms are fair and reasonable, I'll put in 100K, right? It's a non-binding commitment. It's a handshake deal, right? But the beauty of this is it's a lot easier for someone to say yes to that than it is to try to negotiate those terms on the front end. And if you just collect these soft commitments, let's say you're raising $1 million, you get 600,000 in soft commitments, all of a sudden you have leverage, all of a sudden you have momentum. And so you want to reduce the barriers to driving that momentum. You want to drive it as fast as possible so you get a lot of it. And then once you have it, then you want to kind of point it in the direction of like setting terms and catalyzing it and like closing the deal. And that's what we're going to talk about next. But I've seen the soft commitment thing work really well for fundraising, especially for pre-seed and seed rounds. When you get up to raising a Series A or beyond, so much of it is led by the VC that leads the round that the soft commitment approach doesn't do as much. But in the pre-seed and seed stage rounds, in my experience, it's a really big difference maker. So that's something that I've used quite well. Ahva, did you use like a soft commitment approach when you raised your capital, or how did you do it?
Absolutely. I feel like it was really, really important for us, especially like I think at this phase, because like as you mentioned, like later rounds, like you'll have your VC supporting the whole investment, but you'll also have like metrics. So the decision to invest in you is kind of like cut and dry. And like this, at this moment, it's more like, okay, we don't really know too much about the founder, but we believe in the founder. We believe in this market. We believe this founder, this idea might work, and we think they could pivot and do it. So really everybody is relying on each other to really, oh, they said they're in. Okay, well, we're now in. So it's like everyone's trying to be like mitigate risk as much as possible. And that's one way you can mitigate risk is like, oh, my friends did the due diligence and I'm going in. So we always would ask, can we share can we share more about your commitment with others? Can we use your name? And so we would get that like, okay, via email, like written out. And then we would use that to go and get everybody looped in on the round. So I couldn't agree more with how valuable this is, and just make sure that you're able to get that commitment in writing that you're willing to use your name.
Yeah, it's really smart, really smart. Okay, and then a couple other things on momentum, then we're gonna switch to terms, is just you want to reduce latency in the process. So follow up, pretty aggressively, right? Like make sure that when you meet with folks, they give you a next step, whether it's they're going to talk on their Monday investment committee meeting and back to you, or they want to see this information from you, or just try to say, hey, can you make a decision in 2 weeks? Like try to get them to commit to something, so that you have something to kind of hold them accountable to, just person to person, right? And then follow up via email, like put that in the email and broadcast milestones. And like, if you don't think you're reaching any milestones, find a milestone, right? Like, so I'm raising right now, I'm like, hey, we just got this partnership done. Hey, we just did a deal with this accounting firm. Hey, I didn't even have a feature released yet, but one was on like a staging server. So I like took a video and I was like, we got this feature that's like about to drop, or I just got this great customer testimonial. Check it out. Like, find different things that you can just send to folks. And I call just like fluff the funnel, like you got people going through a funnel. You just want to be fluffing that funnel up the whole way, right? Because like you want them always thinking like, man, like this guy's just like sending me cool stuff left and right. Like he's really got something going on over at Forecastr, right? Like, and so even if they're little wins, that's okay. Just like I'll pitch somebody on a Tuesday and I know they're not going to get back to me till next week, but I'll hit them up on a Friday and I'll say, you know what? Really enjoyed our meeting earlier this week. I hope you have a great weekend, and check this out. This thing happened this week. I'm super pumped about it. Like just a little thing like that. Little things like that just keep you top of mind, that, make sure that they're going to talk about you on that Monday investment committee meeting, because they got a bunch of companies to go through and sometimes they don't get to you. Just anything like that. Just always be thinking, hey, like, how could I stay top of mind? How could I make myself look cool? Like, how can I create FOMO and momentum, right? Because I'm like creating this aura around my company that makes it seem like amazing, and that they're totally going to miss out if they don't get in on this deal. So something else that I've been doing a lot lately that works pretty good. So and then so setting terms. So first of all, kind of how are terms set? So a lot of times there's kind of two different routes to setting terms. There's what's called like a lead investor or a lead, VC lead on a round. A lot of times it's where a single investor, typically an institutional investor like a venture capital firm, or a larger angel or a super angel or whatever, just like a bigger investor, they're going to drive the terms. They're going to kind of set the terms with you. And then everybody else is going to either like accept those terms or not. So that like you're going to kind of work with a lead. Maybe you're raising $1 million. They're doing 250K. They're saying, hey, let's do it on a 5 million, valuation cap on the note. You're like, cool. Then you've set the terms of the lead, and then you're going to circulate those terms to the soft commitments and say, hey, I know you committed to investing 100K if the deal's fair and reasonable. What do you think about this deal? Is it fair and reasonable? Are you still in for 100, right? And so that's one route to go. And then the other route is what's called a party round, which usually just means like there's no clear lead. Maybe you're raising $1 million, you got a bunch of 100K checks, or maybe you're raising like 4 million, but you can't quite get somebody to do a $2 or $3 million check. So you're just like, okay, like, you got to set the terms a different way. And one way to do it is take some of those soft commitments. Maybe you got 600K out of $1 million committed, a couple 100K check people, you'd go to them and you might go to them one by one, or you might schedule them 2 or 3 on at once. I like to go one by one just because you use a little leverage if there's like 3 people on a call versus you. But you go one by one, you say, hey, just wanted to update you on the round. Like, we've got 600K out of this million now. It's been going really well. Like, I think that we're going to be filled in no time. We're ready to start putting terms on this thing. And I just wanted to have an open, honest conversation about, what we think the terms should be. Like I told you in my first meeting, don't optimize for it, blah, blah, blah. But like, here's what I'm thinking. How's that sound to you? Or what were you thinking in terms of terms? And then people write whole books on negotiating strategies. So we won't go into that. Anchor first, don't anchor, whatever. But you start that conversation where you just have an open, honest, transparent conversation about terms. And if you can get one person to agree to certain terms, you're like, cool, well, sit tight. I'm asking some other investors. And then you might have the next conversation. You're like, yeah, I was thinking, what this investor said as the terms. You see if they can agree to that. You're like, cool. And then if you can get like 300K out of the 600 all saying like, yeah, those are good terms, then you can be like, cool, well, like we've set the terms with this investor group. Now, like they collectively are like the party lead, right? And you're going to these other investors with those terms. You can also do it like company led. Like you could straight up write a note or a safe or a term sheet from the company and say, hey, we're raising 4 million on a 20 million post, and this is what we're doing. Are you in or you're out? But I think it's best to try to work with the investors and try to have conversations before you do that. Because as soon as you put a deal on somebody's desk, they may be like, no. But if you just have a conversation, you kind of feel out where they're at. And then you can try to set terms that are, of course, fair and reasonable, but also optimize around getting the deal done. Because that's the other thing I think is that, end of the day, it's a pretty binary game, and you'd rather have half a watermelon than a full grape. So don't get too crazy about trying to minimize dilution. It's important, and you want to keep as much of your company, and you deserve it because you're awesome. But if you got to give up a little bit more to get some good investors, get the money you need, get back to work, it's usually within your best interest to do so. So a couple of different ways that that you can approach, setting terms for your round.
I'll jump in there just because I really wanted
please.
to double down on what you said about like approaching it as a conversation. I found that that's been like the best approach that we've ever had with our investors, because like sometimes they'll say something and immediately we're like, that's like, lowballing us on this like pricing or like, that those terms. But, whenever we've gone to them and be like, we'd love to understand how you got to this number, or we'd love to understand why you're going to invest this much in the follow-on round, and then give them kind of the platform to understand why. And then when they start to explain it, they can oftentimes catch themselves sometimes too. They're like, we thought about it this way, but this is how much money we have left in our fund. And that's why we're overextended to do X, Y, and Z. So I feel like that's been really informative for us as we've navigated our relationship with our investors from like the first round to even like follow-on rounds afterwards.
Yeah, I think it's a great point. It's a great point. And another one that an investor, told one of our investors, like he always coaches me on, is like, when you're fundraising, you're kind of in the yes game. And so even if someone does gonna give you a term sheet, right, or whatever, and they're on terms that probably aren't acceptable, like they're too low, that's still a really positive thing, because now you have an investor who's looking to invest, who has terms, and you can be appropriately aloof about that to other investors. You can say, hey, it's been going great. We actually did just get a term sheet from another investor. We're evaluating that with the board right now, blah, blah, blah. And like, even if they're terms that you wouldn't really accept and you're trying to negotiate those up, it's still really positive. And so, he always coaches me. He's like, you're in the yes game. Try to get people over the line, even if it's over the line at terms that aren't great for you, just because you can usually parlay that into other investments that are at better terms, and so it's all this game of building momentum and getting a term sheet, getting an investor to give you terms. That's momentum, and you can leverage that, and you can be guarded with the information. You don't need to tell the other investors who it is. You don't need to tell them what the terms are. You don't owe them that. You just tell them, hey, I've got a term sheet from another investor and we're evaluating it. So like, what do you want to, like, let's do a deal. Let's get a deal done here, Yep. And so then there's a couple other things, and so there's for earlier stage rounds, there's unpriced agreements. So a convertible note is a form of this, a safe, which Y Combinator popularized is a form of this. These might be familiar terms to y'all. those are usually good structures for, let's say, raising like a couple $1 million or less. They're very low cost from a legal perspective. They're easier to get done. They're easier to negotiate usually, versus priced equity, which is typically when you're pricing around, you're setting a formal valuation, you're taking folks directly onto the cap table, they're getting in a piece of the company right away, rather than these unpriced agreements. It's like it's kind of an agreement to get equity in the future. And on the priced equity side, it's usually best when you're doing larger rounds, so typically later stage rounds, Series A, Series B, Series C. These are typically all done priced equity. And they're typically led by a VC. A venture capital firm will typically give you a term sheet, which is dictating the valuation, yada yada, and that would be your priced equity round. So just a few different structures there that you can be aware of. And my mantra always in fundraising is don't create any friction where there doesn't need to be any. So I go into rounds I don't really care what the structure is, because it really doesn't matter at the end of the day. So I don't go into rounds saying, hey, I'm raising 4 million and it's got to be priced equity. I assume it will be priced equity because of the size and yada yada, but I don't really want to dictate that. If everybody just is dying to do a safe, cool. That's okay. Is a lot of times, just doesn't really matter that much from a founder perspective. So I'd say be flexible on structure, be flexible on terms, look to get a deal done, with great people, look to get a deal done very quickly, that kind of thing. Just a couple different structures to be aware of there. And then I think the last thing on setting terms is like you said, I was like, well, where'd you get that number? It's how did you arrive at that number? And this is one of the things that I find is a little black box for folks. And, being a finance guy, I have a little bit of a sense of how it's done. And it's done a lot more simplistically than a lot of people think. A lot of people think investors are kind of doing this calculus and saying, hey, this is the value. It's really a lot simpler than that in my experience. In my experience, it's a blend of market comparables and then what the investor wants from an ownership perspective, and so what that's going to mean is if you approach me with $1 million round, I'm going to say, okay, well, companies that I've seen in your sector, in your geography, at your stage, what are they raising at? Are they raising at 4? Are they raising at 5? Are they raising at 8? Are they raising at 10? What valuation are they raising at? That's the market comparables piece. I'm going to be, as an investor, I'm constantly seeing deals, so I always have a sense of the range. And then I'm saying, okay, well, yeah, they're raising $1 million. I want to do $500,000, and my goal is to typically own 10% of the post-money ownership. I want to own 10% of the company after I put my money in. I typically like to invest $500,000. So that means I need the post-money valuation to be 5 million, because 500,000 divided by 5 million is 10%. And so it has nothing to do with the company and the metrics and the opportunity and blah, blah, blah. It's just I invest 500K, you're raising $1 million, and I want to own 10%. So we could do it at a 5. That's a 1/5. That's 20% of the company. I get 10% of it. I'm happy. So it's a lot of times when an investor puts a term sheet on your desk or something, that's basically all that's going into it. And said differently, it's a number that absolutely can be negotiated on, because it's not like hard calculus it's not like an objective process. And on the flip side, if you're defending a valuation or saying, hey, that's too low, I want it to be this, and they're like, why? You don't need to come up with some kind of hard calculus. You don't need to say, well, I think 8.2%, times my revenue is this, and yet you can just say, well, that's the level of dilution that I'm comfortable with. I think that's a fair and reasonable deal for the company based on the comparables that I'm seeing in the market right now. Those are fine responses. Now, an investor may push back and say, look, I'm not going to go above this. So you either get comfortable with that dilution or not. So that goes back into the negotiation game. But it's okay to say, you know what, I think 4 million on a valuation is too low, because I think giving up 25% of the company, it's just not something that I think is fair. It's not something that I'm willing to do. I think 5 million is a better number. 20% of the company for this round seems fair to me, and those are the kind of deals I'm seeing in the market right now. So a lot of it is that ownership percentage, that dilution tolerance, what other deals are getting done. And then because it's a flexible thing, right? What can drive the valuation up? Momentum, scarcity. If you've got a hot deal, if you're getting different term sheets, if you've got a lot of investors that want in the round, that's going to give you leverage to push that valuation up. versus if you don't, and this investor is the only one that's willing to write a check, you saying you're not going to give up more than this at the company, they're just like, well, do it or don't do it, and so you lose leverage. So the more you can create that momentum and scarcity, the better you are, the hotter the market is, right? Like right now, we're in kind of a frigid market. So you don't get as much leverage, unfortunately. In other markets like 2021, where everybody's making money, valuations, tend to rise. Competing offers. If you have multiple term sheets, you can drive a competitive process. If you're in a geography like, Ahva in San Francisco is just going to by nature get a higher valuation than me in Kentucky, because people in Kentucky don't think at those levels. They're not as big as the dreamers. They're not as much as the visionaries. So they're not thinking about the valuations in the way that Silicon Valley is. So your geography and your investors' geography, it comes into play. As does your cash. Like if you only got a couple months worth of runway, you lose a lot of leverage because you're a little bit desperate. You got to do a deal. If you've got 18 months worth of runway, or you're profitable and you're saying, hey, look, I don't need to do the deal, blah, 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 right? And like you get leverage, you can drive that price up. But yeah, I think that might help kind of you understand maybe how some of these early stage valuations get set and how you can approach the process once you get to that, with an investor. Curious, what your experience has been like, Ahva, in kind of setting terms and how any of this kind of resonates with you or how you've done it.
So I think that we're, when we went out to set terms, we had a pretty interesting experience because we got our first term sheet and we were like so excited and we're like, what do we do with this? And I remember we apparently you're supposed to act pretty quickly, right? Once you get a term sheet. So we had just kicked off our fundraising process and we were actually fairly surprised to get a term sheet so early. So we thought, oh, well, we have all these other conversations going. But one of our managing partners from the program that we were part of said, you have to move quickly. Like you have to let them know within the next few days, are you in or are you out? So, once you get that first term sheet, you really need to be very quick on your toes to be like, okay, all the people I want to work with, I need to let them know ASAP that I have a term sheet. And the wheels literally start flying as soon as you get your term sheet. You cannot sit idle. And then I think for us, as far as negotiations, we were really not in a position, I think, to negotiate because we were so early in revenue. And both my co-founder and myself, this was our first startup, and is our first startup. So we kind of realized we love these investors. And we made the right decision because our investors are absolutely incredible. They've been so helpful to support us. So this goes back to Stephen's first point about the beginning, make sure you bring out your human element, but also bring out your human element because you want to see what their human element is like, because they're potentially going to be your boss for the next 5 to 10 years. So you want to make sure you like working with them. So as you go through this whole negotiation stage, this whole cycle, do you get on the call and get anxiety, or do you love getting on the phone and talking to them? Do you feel like after the call, you feel a lot more clarity, or do you feel stressed after a call with them? And just take note of that, because these are the people you're going to be reporting to regularly. And these are the people who are going to hold you accountable. So it's, it's so much beyond just the capital. So I would share those pieces of insights that we learned throughout the process.
Yeah, it's a fantastic point. And Ahva's first point there is another reason why it's so important to kind of keep investors, close to one another in the process, so that when you do get a term sheet, hopefully you've got some other investors that you've already been meeting with, you can try to trigger and drive that competitive process. Because like Ahva said, the term sheets, they don't last forever. That's for sure. I know we're getting a little short on time, and I just want to make sure we have enough space for y'all to ask questions, especially of Ahva, and her experience and stuff like that. So I'll kind of hustle up here and we'll make sure we got some good time for that. So as far as closing the deal, there's a variety of ways that you can close. A rolling close a lot of times is for safes and notes, where you can just kind of take money as they come until you finish it up. If you do priced equity, a lot of times it's more of a one-time close, or sometimes there's multiple, but you kind of have to round all the money up and then close it at a certain period of time. Not something you would much negotiate on typically. It's just something more around the structure of the round. But then there's these common deal killers. So what can kill your deal? So if you don't have a data room and you're not prepared for diligence, and an investor says, hey, we'd like to do diligence on your company, send us these documents, and it takes you a week and a half to put them together, it's a real signal to the investor like, I don't know, like you might not be totally on top of it. I don't know if you got all your shit together, like, you know, what kind of skeletons are there in the closet, you know, that kind of stuff. And so just try to be prepared on the front end, try to have all that information, all the ducks in a row so that you can be like, boop, there's my data room. It's worth its weight in gold. I'm telling you right now. And don't stall out. So make sure you have all those investor leads when you start running through that process, and you're backfilling the pipeline too, right? So like until the deal is done, it's not done. So just keep raising, keep trying to meet with investors, keep trying to keep the process going so that you don't end up in a scenario where like you're putting all your eggs in this basket and then, you know, it falls through and all of a sudden you got no more leads, your deal is stalled and you got to start from scratch, you know, and that's a really painful process. So just, you know, nose to the grindstone, keep driving until the money's literally in the bank account. And then you can take that long-awaited vacation. And I think we're like 10 minutes out ish. Yeah, we're about 10 minutes out. Okay. So got these, I'll just go through super fast. So ego stroke, everybody likes to think well of themselves, right? So just do some homework on somebody, tell them why you think their background is so exciting, whatever, right? There's like, try to build a genuine human relationship, try to flatter them, that works well. Flip the table. Ask the investor what makes them such a great investor. Why did their founders love them? What love working with them? What can they provide beyond capital? See if you can get them to pitch you. Speak the investor's language, right? Like if they're a quant, try to give them data. If they're like a visionary, talk about the dream, right? You know what I mean? Try to like be kind of a chameleon, speak the investor's language, like to tweak your pitch to meet their needs. Always try to oversubscribe. If you think you need 1 million, go to market saying you need 750 and then oversubscribe it to 1 million. It'll be easier to get the deal done. It's easier to create momentum and scarcity that way. And then the hierarchy. So, you know, don't optimize for terms. Optimize for getting the best investors. Optimize for getting the round done quickly. Get it on the best terms possible. Get it on fair and reasonable terms. You know, you should not be doing a deal, you know, that's unfair. But optimize for getting the right investors and getting the deal done as quickly as you can. I think that'll help you raise capital. And then we are launching on Product Hunt today. So we've been in business for 3 years now. We've got over 600 startups using Forecastr as a financial model, which is super cool. But we've been in beta and we're finally out of beta. So we're launching on Product Hunt, and Calvin can throw this in the chat, but we're doing a super sweetheart deal for anybody that'll get over to Product Hunt and help us out a little bit and help us maybe get product of the day. So would absolutely love if y'all would help us out, give us an upvote or drop us a comment. We're happy to give you $1,500 off your first year subscription to Forecastr, which is a great deal. So you'll get Forecastr for the first year for just $1,000. Comes with the whole year of the platform, comes with a 30-day white glove onboarding with an expert analyst to build your model, comes with quarterly check-ins as well. So a lot of human love and support. So would love yours if you feel so inclined. But otherwise, I think we got some time for questions. So if y'all got some questions, either, you know, for me about like what we talked about, for Ahva about her fundraising experience, don't hesitate to ask. And
just to jump in really quickly before we open it up to questions, I'm just going to throw a few links in the chat here as well. So first of all, please provide feedback for this session for us. We'd really appreciate any and all feedback that you might be able to offer. And then I just want to let you guys know about some events coming up for Graham and Walker. If you're in San Francisco or New York, we are coming to you. So in May 18th, we'll be in San Francisco, and June 14th, we'll be in New York. So if you are in those areas, please come by and say hi, and we'd love to see you. I'll do kind of a full day of programming for early stage founders. Amazing, Rinka, hopefully we'll see you there. And then I just put the link to sign up for our newsletter to see when we'll be coming to more cities. So we'll be around. All right, over to you guys to answer. Does anyone have any questions for Stephen or Ahva? Feel free to just come off mute if you do.
Yeah, don't be shy. Or maybe we answered them all. You know.
I have a question. Hi, this is Anna. I don't know if you want video, but so the environment has changed a lot in the last 6 months, right, for raising capital. So what do you have as far as advice in trying to get through the VC winter, so to speak?
Yeah. I'll throw a couple things out there, and then obviously see what you want to add. So I would say a couple bits of advice for getting through the VC winter. One is really think critically about kind of the round size and dynamic. I think right now it is a challenging market to raise, and so typically that means a smaller round is easier to get done than a larger round, because what happens in these markets when it's hard to raise is bigger companies raise smaller rounds and it kind of compresses everybody down. So I actually just experienced this. I was going out for 8 for Forecastr, and we couldn't quite get it done. We couldn't quite get over the hump. Now we're kind of like we went back to the drawing board. We're raising 4, and that's going better. So I think you can think similarly, and profitability is really critical. So not being profitable, but profitable growth is rewarded in the market more today than growth at all costs or super high growth. Of course people want both. Everybody wants both, but like if you go to market saying, hey, I'm raising less, like I'm raising this amount, right, rather than this amount, and I really want to get to profitability over the next 2 years. I want to get 2x year-over-year growth, that kind of thing. That type of controlled path, profitable path is a better path. And then the last thing I would just say is like, don't get cute, and what I mean by that is like, don't try to get too fancy, try to get too aggressive. Like you should be in the mode of getting deals done and getting them done quickly. And I think as long as at the end of the day, it's a game of survival. So even if you had to do a down round, you do it. If you've raised money before and you have to do it at a lower valuation, you do it. Otherwise, try to do a flat round, same valuation or higher, but optimize around getting the deal done. Optimize around getting the deal done with good people. So I think that's true in every environment. I'm always thinking optimize around get it done, but specifically and when times are tough, I think just really keeping your eye on that. And like Ahva said at the beginning too, try to put all your time into it, because you've got to drive that momentum and scarcity out right now. It's challenging to do. So now more than ever, you need to spend all your time fundraising. I think if you can afford to do it when you're raising.
That's great advice. Thank you.
Yeah, I'll also give a little plug in. If you think about winter and you think about all your resources, think about what's also in your control. Like if you decide not to go out to raise, can you do a small follow-on round? What can you do to maybe reduce your spend? So that's something we did. We reduced spend by almost 30%. And then we did, and we're almost done, but facilitated a small insider round with current investors. And we used Forecastr to show all the different scenarios and models of what this capital would do to get us to that round. And ultimately, when we put our budget together as a team, I had everyone give me, okay, what's an ideal budget that if you had all the resources, we had all the resources like last year, what is the stretch thin budget that if we don't get to those revenue goals, that you can still move forward and still hit the same metrics that we need. So making sure everybody has that mentality too, to be a lot more scrappy than before too on your team.
Yeah, I think that's a great point. Like right now, current investors are your best source of capital. That's for sure. They already got a vested interest in your company. And so, I'm doing the same thing. I'm going to current investors right now saying, hey guys, we're doing this for, I've already got $1 million from them. I'm saying, hey, we could get that to 2. If I could get a current investor to lead the round, right? So I don't have to go find an external one. That would be really great. So really leveraging those current investors, if you got them, is a good one. And then Henry put a question in the chat here. So after Silicon Valley Bank case, how do you see the managing money of the startups after them achieve capital from investors? Henry, I don't know if you're in a position where you could come off mute. I don't know if I'm quite grasping the question. I just want to make sure I can answer it for you. Henry, are you in a position, or maybe drop another note in the chat there? Yeah. So mostly, I don't know if this is the spirit of the question, but cash management's important right now. Financial modeling. Never has financial modeling been more in vogue than it is right now. So it is one of those things where you do want to make sure you have the financial aspect of the business under control, so that when you're asked, you can answer those questions and you can inspire confidence, in that way. But hopefully that gets at it. But yeah,
I think I might have the angle. I could be wrong, but at the end he's asking, like, after you achieve the capital from the investors, based on Silicon Valley and how they crashed, are entrepreneurs and founders still putting their money, like putting all that investment into a bank immediately after it's been invested?
Yeah, well, you're probably right about that. And the answer to that, I'd say, is a lot of folks know. So diversifying maybe 2 bank accounts is a good approach. Going with bigger banks like JP Morgan, PNC, Fifth Third, some of the bigger banks is a good approach. And then you can ask your bank about something called treasury management, which essentially allows them to take that capital and like put it into like T-bills and US bonds and stuff like that. They're fairly short and like cycle to cash, which like preserves it a little bit more. Okay, cool. Yeah, nice, Calvin, you nailed it. So cool. Well, here we are, 3 o'clock.
Yeah.
My time.
Last thing really quickly I forgot to mention is just our AWS fundraising lab session that's coming up, and Forecastr is actually going to be participating in that with us as well for week 3. So I put the link for that in the chat. If you are in the midst of fundraising, this is a great program, 90-minute session once a week for 4 weeks, just all deep diving into a bunch of different fundraising concepts for you. So please go sign up for that, free, register, great resource. All right. Well, thank you all so much for being here. Huge thank you to Forecastr team and Ahva. Thank you for your insight. Wonderful, wonderful session. I'll be sending a follow-up with this recording and a few other details just about Forecastr and what we have coming up. So thank you again. Have a great week, everybody.
Thanks, Jenna. See ya.
Everyone.